Hi there, welcome to The Open, right here on BNN Bloomberg. Let's get to the big stories we're bringing you from our newsroom. Shares in Barrick Mining are higher in the pre-market. The Financial Times says Elliott Management has built a stake in the company valued at least $700 million US. Elliott is an American hedge fund and activist investor that typically tries to force major changes at companies. Barrick has struggled to benefit from gold's rally, largely due to issues at some of its international assets. MTY Food reviewing its options, including a potential sale. The Montreal-based company has launched a review process and hired financial advisors to explore alternatives, including a partial or entire sale of the company. MTY cautions that there's no assurance a transaction will occur. The company is home to restaurant chains such as Cold Stone Creamery, Wetzel's Pretzels, and Mr. Sub. Shares in Home Depot down in the pre-market. The world's biggest home improvement retailer cut its full-year earnings forecast. The company says ongoing consumer uncertainty and continued pressure on housing are affecting demand. Home Depot also reported lower than expected profit and sales, citing a lack of storms that hampered demand for roofing, generators, and other products. There's a look at U.S. futures. We're seeing fresh jitters over the valuations and the huge run that many of these artificial intelligence-linked stocks have had. Let's check out the TSX and how it traded yesterday, and now up almost 21% in the past year. But you can see trading in a range, as the technical crowd call it, over the past while. Let's have a look at oil, see how it's faring, and oil slipping once again below that $60 level. Finally, let's have a look at gold. Gold, of course, gold flirting with its own benchmark, $4,000 US, down slightly today, but it has soared this year. Let's have a look at the Canadian dollar. Then we did see some strength in our currency. It's up more than 1/3 of a US cent. And finally, Bitcoin. Bitcoin dropping. We've seen it at one point trading below 90,000 today. Looks like, this crypto, the criminal's little helper, as I like to call it, losing the affection of some investors. The market sell-off continuing this week as investors anxiously await NVIDIA's earnings. And of course, we have a delayed U.S. jobs report coming out later this week. So AI seems to be something of a cloud over the markets right now. This is interesting, though. Our guest says the U.S. economy would be in a recession this year if it wasn't for all that massive AI investment. We're joined by Colin Graham, head of multi-asset strategies and co-head of sustainable multi-asset solutions at Robeco. Thank you very much indeed for joining us, Colin.
Good morning. How are you doing?
Very good. That's an interesting thesis. The AI investment has been so big that it's kept US GDP positive.
Yeah, I think this is the story over the last couple of years where you've really seen that you've got this two-speed economy where if you look at the NASDAQ, it's done very well. If you look at the Russell 2000, it's done okay, but not as well as the rest of the US market. So you are seeing this two-speed. I mean, some economists call it the K-shaped economy. But yeah, we see this bifurcation in the economy where earnings would have been in a recession last year if it hadn't been for the Magnificent Seven.
I mean, is that okay to have just one pillar of the economy doing well while the rest is lackluster or even declining?
It depends where you sit in the economy and if you're an investor. then you're investing in the index. You're not necessarily investing in the economy. From our perspective, these companies have delivered their earnings and have supported the valuation multiples that they've been on. And so at the moment, we see this as being a natural pullback in a bull market here. However, once we see the Nvidia earnings tomorrow, and it's more about the reaction to the numbers that will give us more insight as to the direction of the equity markets. But I think it will also give us an idea of the direction for US interest rates and indeed the US dollar.
Nvidia presumably will come out and beat the drum for AI, say the massive spending will go on. Do you think investors are becoming a bit skeptical, though?
I think the market's telling you that. We can't get good sense on the volumes that are going through here because where are investors, retail money likely to come and say, oh yes, is it 180? Is it 175? Is it 170? Is that the level I'm willing to repurchase my Nvidia stock? And we don't know. We can see that the market can gap down, as we saw in April, without anything going through the market. So from that perspective, it's very important to really understand the market reaction to Nvidia and whether they think that. And on the other side of that, we've seen increased issuance in the debt market for these companies who don't necessarily need to come because they have big cash holdings on their balance sheet. So again, this is another area we're watching, saying, why are they trying to get their weighted average cost of capital down? Is this some way of sort of improving the balance sheet, making the balance sheet more efficient? We know when we look at the underlying data that the promises around data centers and processing power, they haven't given enough capex in order to deliver that. So we know there has to be some other flow coming back into the AI ecosystem rather than just the announcements we've seen.
Actually, let me ask you about British policy. Britain, like so many other countries, wants to be an AI superpower. Is that a national worry that this thing is just going to be centered in China and America, and that Britain, even though it has a great tradition of computing, will be an also-ran?
I think it's all to do with the capital markets and the policies that have been put in place from there, because we can see that this bipolar world, and if you look back at our 5-year expected returns, our flagship publication last year and the year before, we talked about this bipolar world between the two spheres of influence, China and the US, and the AI and the technology side is definitely one of those bellwethers around how the two ecosystems are trying to diverge, if you like, from the current model. So from that perspective, I think China and the US are going to lead, but it also provides opportunities for other countries to get involved because you can then trade with both sides from that perspective. So yes, it's difficult for those countries that are caught in between, but there is a path to prosperity there.
Go down the middle. That's interesting. Now, just to get back to the U.S. economy, you reckon it is running hot enough so that if there's stimulus from Trump's government via the big, beautiful bill, it risks overheating activity. And of course, that tends to bring up interest rates again.
Yes, and I think this is where you're seeing, I think the major trade that all fixed income managers have on at the moment is the curve steepener. So this is where you expect long yields to go up and short yields to come down. So, and that is effectively where we are. And we think that if that happens and interest rates come down with the tax cuts that are promised for next year, then this is going to really put a high pressure economy in place in the US. And usually when you see this, there's other mechanisms that can release the pressure. So in previous times, previous cycles in the 90s and the 2000s, the US imported deflation from China. But with the trade concerns at the moment, that isn't necessarily going to be a channel that will help relieve the inflationary pressure within the US. You're also seeing the reduction in immigration. So you're seeing wages still growing at 4%, according to the Atlanta Fed. Admittedly, that's a couple of months out of date. But yeah, that's still above inflation at 3%. So from that perspective, the consumer looks okay if you have a job. And so that's why everybody's focused on the job numbers, and it gives room for the Fed to cut further. So yes, this is going to cause stimulus to go into the economy without the usual outlets to keep inflation lower. So our view, and we've just launched our one-year outlook, is that actually you are going to see inflationary pressures come back in the US.
You have a thought for us here. You're watching the Vietnamese economy. Vietnam, of course, has been getting a lot of spillover investment from China, but it's a lower cost base country. What draws you to Vietnam, though, broadly?
Yeah, look, Vietnam is for our emerging markets, equity investors and bond investors. They look at this and see a very good story. So we're in the multi-asset, global, top-down macro. So we sort of leave that to them to decide. But then we look at that and go, actually, there is a really good story here. I think the continuation of the outsourcing, to lower cost areas. And I don't know if you've been to Vietnam, but I've been recently, and it's night and day compared to where it was 20 years ago in Vietnam. So yes, there is growth there. Yes, there's manufacturing, but there's always this overhang of does US trade policy change in order to say, well, actually, you're part of the China ecosystem for exporting goods. Therefore, you should think about should the tariffs also apply to Vietnam at a higher level?
A big population, north of 100 million. We just showed a VanEck Vietnam ETF. I know you're not talking about that, but certainly it just illustrates how there's been money going into Vietnamese stocks over the past while. Thank you very much, Colin. That was great.
Thank you very much, Andy.
Colin Graham, head of multi-asset strategies and co-head of sustainable multi-asset solutions at Robeco. Coming up, U.S. lawmakers are set to vote on a bill to force the release of the Epstein files. We'll be right back. So the annual inflation rate in Canada now about 2.2% year over year. It has cooled slightly. For a closer look at the costs Canadians face, though, we got this report from CTV's John Venevali-Rao.
While the price of gas is still higher than many drivers would like, StatsCan says the cost for that fill-up has been coming down, with prices falling more than 9% compared to a year ago and 4% in the last month, in part as motorists switch to less expensive winter gas blends, along with another big factor.
This is still being affected by the removal of the carbon tax earlier this year.
And at the grocery store, prices also coming down, falling more than 0.5% from September to October, the biggest monthly drop since 2020, while year over year, prices are still up 3.4%.
Maybe I've seen some small relief in some areas, but still generally higher than they have been.
A lot of things are definitely still pretty expensive. Some things are definitely a thorn in my side, like the price of beef, for example.
The 1 month fall attributed in part to the elimination of many counter tariffs on U.S. products.
The food inflation rate dropped, which is certainly good news, and we were expecting it, to be honest. There's less pressure at the border. Counter tariffs are gone now since September 1st, and it's helping. It's helping.
It's all contributing to overall inflation coming in at 2.2% in October, down from the previous month, though notably some items getting a lot more expensive. Cell phone plan prices rising around 7% year over year, as did home and mortgage insurance and car insurance.
When we talk about stickiness of underlying inflation, insurance is really a big issue, and it's a big issue right across Canada. and I'm sure most homeowners and people, vehicle owners are really feeling this.
Rent also up 5% year over year. Meanwhile, the numbers released today has economists now betting the Bank of Canada will hold interest rates steady for the rest of the year. Jonathan Navalny-Rao, CTV News, Toronto.
The U.S. House of Representatives is set to vote in a bill today to force the Justice Department to release the case files on Jeffrey Epstein, along with information about the investigation into his death in federal prison. This comes after President Trump reversed his position on Sunday. He urged House Republicans to vote to release the files, but that was days after a House petition gained enough support to force a vote. Let's get more from CTV's Scott Hurst. Scott, take it away, please.
Good morning, Andrew. After months of pressure building on Republican lawmakers and the White House to release the files related to late sex offender Jeffrey Epstein, now a vote in the House of Representatives today. The member is expected to begin debate and take up the issue later this morning with a vote possibly by this afternoon. The measure, which last week, as you mentioned, secured enough support even to reach this point, and then U.S. President Donald Trump over the weekend seeing his support from Republican lawmakers who themselves under increasing political pressure to release the files, shifting his stance on the issue, reversing course, urging Republicans now to support it. Now, the vote is all but certain to succeed in the House of Representatives, but there is still an uncertain timeline on whether the files will, in fact, be released. The bill, after a vote in the House of Representatives, Andrew, would then need to go to the Senate for a vote as well, which the Republicans also control. And it's unclear whether the Republican-led Senate would take up the matter. Then it would need to go to the desk of the U.S. president himself for his signature, which he said yesterday he would sign to release these files. But also, Donald Trump does even right now, with his signature, have the authority to compel the Justice Department to release the files. Trump himself, in the run-up to the latest election, which he won and returned to the White House, often fanned the flames of conspiracies about the Epstein files, but since returning to power, Andrew has dodged many calls to release them.
So this was seen as something of a shocking reversal by Trump?
Yeah, significant reversal by Trump as the Republicans, Trump in the White House and Republicans controlling the houses of Congress have been delaying getting this vote to the floor of the House of Representatives, which, as I mentioned, Andrew, really is a first step here through the congressional process.
It's interesting, just the powerful people associated with Epstein. Apparently, Larry Summers, former Treasury Secretary, a Harvard University professor, says he is stepping back from public commitments after being criticized over his correspondence with Epstein. So some big names caught up in this story.
Yeah, Andrew, ultimately, the release of the files, what they're urging the Justice Department to do is release all files and communications related to Epstein, as well as any information about the investigation into his death in federal prison. Now, technically, this measure is called the Epstein Files Transparency Act and would compel the Attorney General, Pam Bondi, to release investigative files on the late sex offender Jeffrey Epstein, which, as you pointed out, which detail many of his connections to the rich and powerful, as he had for many years established an enormous network of wealthy and influential connections. In some files that had been released last week, we've seen the prominent names once again, like former Prince Andrew and Donald Trump amongst his network, as Trump has acknowledged he once was a friend of Jeffrey Epstein, but claims they did have a falling out many years ago. And Trump, Andrew, has consistently denied any involvement in Epstein's crimes. So we'll continue to follow the vote in the House of Representatives today. But, Andrew, there are many steps that still will need to happen for the official release of these files.
Scott, thank you very much indeed. Scott Hurst of CTV News. Up next, we're going to update you on the markets and check out a couple of early movers. Let's have a look at the Asian markets because there's an extraordinary story there. The new Japanese Prime Minister has indicated that Japan might be interested in military measures should China attack Taiwan. And apparently the Japanese bureaucrats are frantically trying to soothe Beijing. Beijing is demanding that she retract her statement and has already unleashed economic measures. The Japanese are warning tourists to China to avoid crowds. Incredible, really. She's outspoken. She's seen as a nationalist, and she came out and said that there could be a possible deployment of Japanese troops in the event of a Taiwan Strait crisis. And Beijing did not like the sound of that. Let's have a look at European markets now. And you can see they were under pressure. Around the world, this sell-off in tech stocks, or certainly jitters in big US tech stocks, is creating ripples. And let's have a look at US futures. And you can see they are set for another weak open today. Over the past 5 trading sessions, the S&P is down about 2.5%. That's interesting. The NASDAQ, according to my screen, has actually declined less. It's only down about 1.3%. Toronto is down about 1%. Let's have a look, actually, at the TSX over the past week. And you can see, yeah, it's down about 0.8%. Let's check out gold once again. And gold moving higher. Copper still near record highs at north of $5 a pound. Barrick, apparently the market likes the sound of a possible restructuring in which it would separate its African and Asian assets from its U.S. holdings, the vastly rich Nevada mines. And Financial Times says that the obstreperous shareholder, investor, Elliott Management, is pushing for some kind of a change at Barrick. Let's have a look at Home Depot, cutting its forecast, warning that consumers are not spending on the particle board, partly because of weakness in the housing market. PDD, Chinese company, parent of Temu, the vendor of cheap stuff online. Great source, though, for bicycle lights, let me tell you. That stock down. It's trying to, Temu trying to mount a comeback in the US with big price cuts because a key tax loophole was closed, the exemption on lower value parcels. And Baidu, another Chinese e-commerce giant, posting a big revenue slide, revenue down 7%. The core search ad business is losing eyeballs, apparently, competing with social apps. They're attracting the advertising. Up next, we've got the opening bells. Here are the opening bells at the NASDAQ and the NYSE. At the NASDAQ, it's Chaggi, or Chaggi, which is a Chinese vendor of tea-based drinks. At the NYSE, it's the rare earth player, MP Materials, celebrating its 5th anniversary of listing. It's time for the first 50. Let's check in on the equity markets. We did get weakness in U.S. futures before the open, and you can see we are getting a soft open once again amid fears that there's too much euphoria in the AI-related stocks. And let's have a look at MTY Food Group, that company seeking a possible buyer, but warning investors that we may not reach a deal at all. But you can see the stock jumped yesterday, and I'm just looking here. Yeah, so the company itself. The company itself saying that we are looking for possible alternatives here. Let's get some movers south of the border. We're joined by Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities team. Jeff, update us on Home Depot, please.
Yeah, Home Depot having a rough one this morning. It is the worst performing stock in the S&P 500. Not only did third quarter results miss expectations, but the guidance for the full year was cut. Analysts across Wall Street are citing a combination of headwinds, a little bit lower spending on big ticket items in the United States from Home Depot. Part of the reason for that is a little bit milder weather. People are, I guess, spending a little bit less money on either repairs or on weatherproofing. Another analyst at Bernstein saying that this is going to kind of reinforce the narrative that the U.S. economy is slipping a little bit. So Home Depot down sharply this morning. It is, as I said, one of the worst performing stocks in the S&P 500, and it's also dragging down some peers with it. Lowe's in the pre-market session was also down.
Cloudflare helps you manage internet traffic, including video streaming, load balancing. Investors not loving that stock today.
Yeah, well, the issue with Cloudflare this morning is that they've had a number of outages, and it is impacting companies kind of in various sectors. X, the company formerly known as Twitter, is down or has been down this morning, partly because of this Cloudflare outage, as well as ChatGPT. OpenAI uses Cloudflare. So Cloudflare has had some pretty significant outages this morning, and the impact you're seeing across a number of places. So if you tried to open your Twitter/X feed this morning and couldn't get in, that's the reason. The stock is getting hit as a result.
My daughter suggested that I just delete the apps from my phone, and that is actually a help. Anyway, Freeport rising. Tell us about that big copper and gold company.
That's right. Freeport is rising. This is one of the top performing stocks in the S&P 500. So they had that big mudslide at one of their mines in Indonesia earlier this year, and the stock was down sharply after that. Now they're putting forth a plan to reopen that mine, moving ahead with some of that, and you're getting a bit of a lift here this morning. That is largely what's happening with Freeport. It's more of a micro and company specific story than it is a broader one. That Grasberg mine is really quite a big asset for them, and so this is a positive this morning for Freeport.
Thank you very much. That's Bloomberg's Jeff Morgan. After the break, we're going to be joined by Leslie Marks. She's going to drill into these trade tensions and the impact on Canadian markets and the economy. That's after the break. So we are seeing these cracks in the AI stocks, but of course, bull markets often have down periods. Let's get more from Leslie Marks, Chief Investment Officer at Mackenzie Investments. Leslie, thank you very much indeed for joining us. Let's pop up a one-year chart for the NASDAQ 100 as a proxy for the AI stocks. What do you think? Does this feel like a decisive turning away from these big tech names? And they still have soared, obviously, over the past year.
Well, of course. And I mean, it's interesting to see how people have so quickly jumped on this bandwagon of the negative sentiment around AI. Just, a week or two ago, there was nothing, negative one could say, and the prices were just, basically moving straight upward. So I think this is a very healthy pullback or correction for our markets. When you look at the broader market, the S&P, for example, is only down 3.5%. I mean, I know it feels like a lot more because a lot of the stocks that were darlings, to your point, in this AI price run up are off, more than 10%, and some I've been looking at in the 20% range. So kind of feels worse than it really is right now. But I think that's because of the narrowness that we saw in price appreciation for equities.
What about gold? What are you telling clients about gold right now?
So gold has also been part of this same momentum trade, if you will. We've seen gold trade very much like stocks leveraged to the AI trade, leveraged to Bitcoin, for example. Again, I want to highlight the narrowness in the market. There were a few very key themes that have been driving stocks. And so what we're seeing right now is a high correlation between all of these key themes in the sense of a pullback. And so what is the common thread here? I think the common thread here has been retail interest in a lot of these themes. And what we have seen over the last couple of weeks is a decline in retail investors' participation in the themes. And that's really taken the froth out of a lot of these markets. So I think we ultimately will end up in a better place where stocks, commodities start trading on their fundamentals as opposed to this strong momentum push that's really been the dominant factor this year and really part of what's been driving the gold price higher.
You're a great person to talk to about the sentiment among investment advisors and planners. Tell us, have they changed their minds about AI? I guess it's difficult for them, isn't there? I guess they have some clients saying, why aren't you matching the NASDAQ? Why aren't you keeping up with these AI stocks? But that can be a dangerous strategy.
Well, Andy, it sounds like you're certainly living in my head or my life right now. This is a very common question and concern that we get from both advisors and from end clients. They see the big numbers. They see, what their friends are investing in cocktail party chatter. And there does seem to be, or there has seemed to have been a lot of chasing of these big returns, which has really been contributing to the detachment of valuation from fundamentals from a lot of stocks. And use gold as an example as well. So I'll add on that in the commodity space. So we do need to have a bit of a reality check. And I think what the most important thing to focus on is as an investor, or an advisor, what are you trying to achieve in your portfolio, and are you achieving those goals? Not are you maximizing returns, because returns have been very strong for investors, not just in the broader markets, but portfolios in general, even if they've been lagging these key benchmarks. I think most investors have done very well by their own financial plan based on the general strength that we've seen globally across equities. So we want to always come back to what are the goals of the portfolio, and are we meeting those goals? And those are typically not necessarily to have the greatest return that you can possibly achieve.
The Canadian economy, the budget getting shrugs from some because it wasn't decisive. Really, there wasn't much at all about spending cuts. And there is spending on infrastructure, but there wasn't stimulus in terms of actual big corporate tax cuts.
Well, I think that the intention here is really to turn the focus towards capital and infrastructure spending to drive what we commonly would refer to as the multiplier effect in the economy. If we invest in the economy and that helps to offset a shrinking government, then net we will end up in a much stronger place, particularly when it comes to productivity, which has really been a sore spot for Canada and for Canadians. We really haven't achieved the productivity levels that we should. And part of that, or most of that, is due to a lack of investment. So I think the focus on infrastructure is right. What we need to see is this to actually happen. Right now, there's a lot of talk. We want to see the action. We want to see those shovels in the ground. We want to see those projects happening, and then we will benefit from the multiplier effect on our economy.
And the Bank of Canada, does that have a big effect on retail investor sentiment, do you think, when the short-term interest rates come down?
Well, the Bank of Canada is maybe less important when it comes to sentiment, but it is more important when it comes to the average Canadian. The average Canadian's biggest asset tends to be their real estate or their house. And people are buying and selling. And what we are seeing when we have high interest rates, particularly on the short end, is not a lot of activity and a lot of pain in the housing market. So we want to make sure that we have stability in our housing market. That's really important, as I said, for the average Canadian. And so the Bank of Canada's decisions do tend to impact how the housing market behaves. We're starting to see more transactions, but prices are still on a downtrend in housing. And of course, we don't want that to get to a dangerous level where people are, forced to sell their house at prices that put them below water from, where their mortgage is at or, where their cost base is.
Leslie, thank you very much indeed.
Thank you, Andy.
Leslie Marks, Chief Investment Officer at Mackenzie Investments. Yesterday on Market Call, we were joined by Eric Nuttall, Partner and Senior Portfolio Manager at 9 Point Partners. Of course, he was talking about energy stocks. His top picks were Whitecap Resources, Expand Energy, EXE on the NASDAQ, and Antero Resources in New York. Today on the show, it's Colin Shazinski, Chief Market Strategist at SIA Wealth Management, and he'll be taking your questions on technical analysis. Coming up, it was a close one, but in the end, the Liberals' budget passed last night, and Carney's government survived its first major test. We'll be right back. Federal budget motion passed in a final vote of 170 to 168. So the government narrowly survived. Heading into the vote, the Liberals needed support from either 2 opposition MPs or they needed to see 4 opposition MPs abstain, along with the support, of course, of all 169 Liberal MPs. Let's get more on the math here from CTV's Colton Prale. Colton, thanks very much for giving us the time.
Absolutely. Yeah, the situation changed a couple hours before the vote when Elizabeth May, the Green Party leader, announced that she would be supporting the budget. And what's interesting here is that she didn't really get a lot from the government in order to do so. She got a commitment from Mark Carney that he would uphold Canada's already existing commitment to the Paris Accord climate change goals of 40 to 45 and then 45 to 50% reductions in greenhouse gas levels by 2030 and 2035 respectively, that he would uphold the Montreal Agreement, which relates to ozone health, and that he would bring forward a piece of legislation that he's already planning to bring forward with regards to nature preservation, and specifically around 30% of the oceans and 30% of species in Canada is what we're expecting to see in that bill. And so with that support, the magic number for the Liberals changed to 2. And that's an important number to point out because the abstentions we saw in the vote itself were 2 NDP MPs and 2 Conservative MPs. In effect, both parties made sure that no matter what anybody else did, this budget was going to pass even as they voted against it, that the Liberal government would stay in power. And it just highlights how much opposition parties did not want to head to an election. And the fallout from today, the fallout or from yesterday and where we move forward from here is going to be really interesting to watch for every party. For the NDP, they're positioning this as a vote against the budget, but at the same time respecting that their constituents didn't want an election. Meanwhile, all outsiders can see that this party cannot afford an election. And so there were questions about whether or not they allowed a budget that they say is bad for workers to go forward in order to help their party be better prepared for the next time around. For the Conservatives, they've said that this is a credit card budget, maxing it out, stretching the finances of the nation to the limit, hurting Canadians in the future in order to get little gains today. That's been the criticism that they have launched. But at the same time, they also ensured that this vote would go through. That they even had their House leader and their caucus chair voting virtually, despite being in the House of Commons. And they only made those votes at the end after the results were known. Now, both of them claimed technical difficulties. It's important to point that out. But former Conservative cabinet ministers have come out and suggested that this shows that perhaps they were also willing to abstain and even reach that 4 number that was originally the limit to ensure that this passed. In both cases, you're seeing parties vote against the budget, saying it's bad for Canada, but doing enough to make sure it passes so that the minority government situation continues, that they have a better opportunity in the future to topple government when they feel they are better positioned for an election. And so there will be a lot of politicking. There will be questions asked about the opposition parties, about just how much they actually oppose these budgets. And for the Liberal government, the same questions, but flipped. You know, did they do a good enough job negotiating with other parties? Because what we saw today, and what we saw yesterday, I should say, was a game of political chicken where they relied on the fact that the oppositions would blink first. And they did. But that won't always be the case. And this government has said they have a strong mandate, that they would govern like they had a majority. But the truth of the matter is they do not. They are still a few votes shy. And do they need to be doing more to work with other parties in Parliament? That's going to be the question to Mark Carney, and certainly something that he'll have to answer to today as well. Colton,
thank you very much indeed. Colton Prale, our CTV News colleague. Coming up, we're going to get the latest on Barrick from Lindsay Biscaya. It looks as though investors like the idea of the company possibly breaking itself up into 2. And then we are going to talk about Bitcoin and the sell-off there. We'll be joined by Bloomberg's Mike McGlone. The Financial Times of London says Elliott Management has built a, quote, large stake in Barrick Mining. We're joined by BNN Bloomberg's Lindsay Biscaya. So just remind us about Elliott, because they do like to make their feelings known to executive teams.
They do like to make their feelings known, yeah. So for people who maybe don't know, Elliott Management is an American hedge fund and activist investor, typically known for getting involved with companies and making really dramatic changes. There's a couple examples of that. So Elliott took out a stake in Honeywell, which is an American company that really focuses on aerospace, sustainability solutions, and energy. And Elliott is now pursuing a breakup of that company, of Honeywell. They're also a large, in part, owner of PepsiCo as well. They have a $4 billion position in PepsiCo, which makes them the largest shareholder of that company. So they do have a history of getting involved in other companies. And so this report is out today. We're still, of course, working to get this confirmed independently. I have reached out to Barrick Mining and Elliott Management, have not heard back yet. But the report says that Elliott Management is taking out a quote unquote large stake in Barrick Mining. It's valued at as much as $700 million US. It's been widely speculated, though, that this might happen. Barrick Mining has not had the greatest year. It's been going through a bit of trouble, showing some signs of decline. For example, gold production in 2024 was 3.9 million ounces, which is down from 5.4 million ounces a few years back in 2019. And this year, we haven't seen it largely benefit as much from that kind of gold rush that we've seen other companies really benefiting from within the gold industry, partly due to a combination of factors, including disagreements with the direction of the company. We saw the CEO of the company, Mark Bristow, step down in September because he didn't agree with the direction that Barrick Mining was going in. It's still waiting to confirm, of course, these reports. If this were to happen, this would put Elliott's stake at among the 10 largest investors within Barrick Mining.
And according to the Financial Times, it's citing its sources, apparently Elliott likes the idea of breaking Barrick up into two.
Yeah, and so there is reports as well that Barrick Mining is considering splitting the company into two, having part of it in North America, the other part in Africa and Asia. Again, this is just rumors that we've been hearing about the company. There's also apparently other options on the table, but splitting the company as two is one of the main rumors that we're hearing. It appears Elliott Management might want to take advantage of that, the fact that the company would be splitting into two, and really take advantage of the North American side of things.
Lindsay, thanks very much indeed.
Thank you.
Lindsay Biscaya. Bitcoin now giving up all of its gains for 2025. What could stop it going lower into the year end? And what are the implications for all so-called risk assets, more volatile investments, including the entire stock market? We're joined by Bloomberg Intelligence Senior Commodity Strategist Mike McGlone. Mike, great to see you. We'll put up a one-year chart for Bitcoin. What do you think is weighing on the crypto right now?
Well, hello, Andrew. I think what's happening is the launch of ETFs, the pile-on, and the re-election of President Donald Trump represented a peak in Bitcoin. It went from a space that was really nascent and had a lot of insiders and tech geeks involved into the mainstream. They're piling into poor performance. As you pointed out, it's tilted down in the year. The key question is, where does it go into the end of the year? And my bias is it goes lower. It might recover and maybe get to around 100,000. That's the key inflection point. But number two reasons I'm very bearish for it to continue lower is the volatility in the stock market. 120-day volatility is about the lowest. If it ends here since 2017, it's very bearish, so that has only room to go up. And if you look at the Bitcoin to gold ratio, the ounces of gold per Bitcoin have broken down through key support, which is around 25, and that's around 22. Our model says it can easily go back to 15. So the question is, what might stop this downward trajectory? And we get to that time of year where you're more likely to hit sell stops on a losing position.
That's interesting, yeah. People sort of clean up the portfolio at the end of the year. So as of November 17th, the Bloomberg Galaxy Crypto Index down about 14% on the year. Now, is that an index that tracks Bitcoin stocks?
No, it's all tracks just to cryptocurrencies. The thing is, when we created it, we made sure it had a cap. A lot of these indices don't cap, so most of them are 70 to 60 to 70% Bitcoin. This one's capped at 35%. So 70% of the index is Bitcoin and Ethereum, which just means it's more widely rounded. But I'm glad you mentioned that. To the peak, on October 6th, it was up almost 30% in the year. Now it's wiped that out completely and it's down 14%. So what happens towards the end of the year? I think what we're finding out is most people who invested in these cryptos are finding out through ETFs are getting twice the volatility and very poor performance, and they're just getting out. And the key question is, what does that mean as we trickle down until next year with momentum? And I'm afraid the momentum is going to accelerate.
You have a chart for us. It is a bit technical. It shows the so-called candle trading pattern for Bitcoin. It's the green area there. What is that telling us, Mike?
It's telling us, I think, the key thing I'm seeing from that, Andrew, is Bitcoin can easily get back to 50,000. It was a key inflection point for certainly like the last 3 or 4 years before it broke out higher. And one thing I love hearing from Bitcoiners when they say the bullish things, they say, take a look at the chart. I say, okay, look at an annual chart. Reversion towards 50,000 would be meh, would mean nothing. And I think that's where it's heading right now. It's going to take something extraordinary, I think, to go back up in the year. And as I pointed out, I think the risks are everything tilts lower. And I think I'm afraid it might drag down the stock market with it. Because as Bitcoin started rolling over on its 200-day moving average, MicroStrategy, which is a leverage measure of Bitcoin, has rolled over on its 200-day moving average. The VIX is just starting to recover. And I'm afraid that the stock market might roll over too.
Yeah, right. MicroStrategy, of course, renaming themselves as, Strategy, and they're just a Bitcoin treasury company. A lot of those, because they were trading, in some cases, at a premium to the crypto coins they held. Investors wondering, well, why would I pay extra for a company that just holds crypto?
Exactly, and they're hitting stops now, and they realize, unfortunately, with most of the cryptos, there was one in 2009, it was Bitcoin, and now there's 27 million. So there's unlimited supply of these things, and I think we're starting to realize most of them have no basis, except for crypto dollars, at least track the dollar, and I think they're finding out, okay, we maybe need a good purge in this space before we find a decent bottom, and I think the purge is just getting started.
Oof, Mike, on that note, we'll have to say goodbye. Thank you very much indeed. Mike McGlone of Bloomberg. Gotta take a break. More market action after this. Welcome to the second hour of the Open. Lots more fun ahead. Let's check out the big stories we're bringing you from the BNN Bloomberg newsroom. That's interesting. Now, shares in MTY losing a bit of altitude, but they did jump yesterday on a report that the restaurant franchisor and operator has launched a strategic review process, and the company now confirming that, saying it's exploring options. Of course, they could include a partial or entire sale of the company. But MTY warning there's no assurance a transaction will occur. MTY's food court focused brands include Mr. Sub, Baton Rouge, Extreme Pita, and Thai Express. Shares in Home Depot down. That's after the home improvement giant cut its full-year earnings guidance. The company says there's ongoing consumer uncertainty and continued pressure on housing. Home Depot posted lower than expected profit and sales, saying demand for big ticket items such as roofing, generators, and other categories has been weak. And there is a look at the TSX down a little. Maybe we could pop up a chart for TELUS here, telecom giant, and of course, a competitor to our own parent company, BCE. We got a thanks control room, we got a downgrade of TELUS. JP Morgan cutting to a sell, citing competition and potential share loss, market share loss for TELUS's internet segment in Western Canada. And let's have a look at the US market, see how they're faring. And they too are under pressure as we await those NVIDIA earnings. That's NVIDIA down now about $5. Tesla down about $7 among the big value traders. Alphabet down, you name it, Meta. So just about all of these internet giants, the hyperscalers, down across the board. That's interesting. Apple holding its own. And just a reminder, that the market, really investors around the world, are awaiting those NVIDIA quarterly results, and they are due tomorrow after the market closes. Quick look at oil, see how it's faring. It too is down. When you get the stock market under pressure, frequently oil sees some selling as well. And let's have a look at gold. We'll see if there's any flight to not much, nothing really. Gold slipping, but only about 0.5%. And finally, the Canadian dollar. And it is showing some signs of strength. I'm just looking at the US currency here. The US dollar marginally down against world currencies right now. Let's get more on this market weakness. We're joined by Diana Avigdor, Portfolio Manager and Head of Trading at Barometer Capital Management. Diana, thank you very much indeed for joining us.
Morning, Andy. Thanks for having me.
What's your feeling in the market? Are you getting a feeling of fear and nervousness that this AI thing has been overdone?
Definitely, we can see the CDS spreads are blowing out. I think it all started when they started raising debt. And we had Amazon raise more debt yesterday, and the demand for that debt has been multiple times covered. So it's not like people don't want to have access. And let me just add in, just for context, the NVIDIA earnings tomorrow. We're expecting 57% growth on the top line and 55% growth EPS and 73% margins. So it's trading at 30 times next year's earnings. I just want to say this so that we can have a context as to how big the numbers are, and it is 10% of the NASDAQ 100 and 8% of the S&P. So, it's normal and probably healthy what's going on right now in terms of the little check back. The market is having a little bit of a tantrum. There is a little bit of a pile on of negativity, and definitely breadth, which we watch very carefully, has been deteriorating in the last few weeks, which for our tactical active strategy meant that as stocks break down, we just leave it in cash. We're in a no-buy zone. And one other point before we move on to another question is you really have to mind your time horizon. If I'm talking to the short-term traders right now, they're going to stay away until this stabilizes. But for the longer-term investors that, put money in their RSP every month, that strategy should not change.
It's interesting you mentioned the debt that these tech companies are taking on. There's a headline on Bloomberg, AI debt supercycle isn't nearing the end, likely just beginning, because the AI capex is projected to soar towards $3 trillion US over the next 5 years. And debt is becoming the funding tool of choice. As you mentioned, Amazon, other tech giants issuing bonds.
Yeah. And, the other thing that seems to coincide is when JP Morgan reported a few weeks ago when the U.S. earnings season just started, they mentioned one investment that went sour. And the market and traders are split camps almost evenly, whether that is something more substantial to watch, because Jamie Dimon said that where there's one cockroach, there could be more cockroaches, and that's certainly true. But there are those that think that this was a one-off, and there are certainly sometimes not so great investments. But, when you look at the larger spreads like the IG and high yield, investment grade and high yield spreads, it moved up slightly, but not substantially. And, the other thing that is kind of triggering a little bit of fear, and now there is a pile on of negativity, of course, because everybody's watching the yields on the Japanese bonds moving up and how that might suck money out of the North American market or the U.S. Treasuries. But we've seen U.S. Treasury buying as well. So, the facts don't always match up exactly to the potential narrative. And yes, we might have a little bit of a tantrum on the carry trade that everybody's watching. So again, this could be healthy. We're coming into this today with about 20% cash because, as I've mentioned, as Brent deteriorates and if stocks move down, we tend to be very disciplined sellers. So, when gold started trickling down, we've gotten out of the golds. We have since, and we booked nice profits, but we have since added them back in a little bit to a certain extent, like maybe 3 to 4% of portfolios. We've also taken some profits in Celestica, did not sell it out, just brought clients back to a regular weight from a high weight. So it ebbs and flows, and we ebb and flow with it.
That's it. So CLS, let's put up a one-year chart there. You're not out of CLS because they built a wonderful franchise, it seems, in installing data center equipment.
It really is. And then, you have to have some growth in the portfolio. And this is where the growth in the Canadian stock market exists. So we'll see. We'll see if it breaks down. We're of the opinion that we let pricing and the market tell us what to do. If it breaks down, we'll take it further down, and there'll be opportunities to get back in. So we manage this. I guess this is not about return right now. I guess this is about risk management. And again, if I'm talking to short-term traders, they know exactly what I'm talking about. This is not the time to step in, but there will be a better feel to step in, to add to positions or to initiate new positions. So for now, it's a no-buy zone. We will watch, we will re-engage, like say NVIDIA tomorrow reports and let's say legitimizes all this AI fear and gives us another leg. We will re-engage. But should it not, and I mean, lately the volatility around NVIDIA's earnings has subsided. We are pricing in about, the options market's pricing in about 6% move tomorrow for NVIDIA. But, we used to have a lot more. And lately the stock hasn't really been moving all that much given its size. So we'll see. Everybody's watching. And maybe perhaps people are worried with the government in the U.S. reopening. We're going to have a pile-on of economic data, and there's been lots of talk about softness in the labor market, but we've had ADP came in line, and we've had jobless claims came in this morning early. It was benign, and Canadian inflation is at 2.2%. So it's kind of okay, and if this is healthy, it's a good check back.
Dana, we better jump. Thank you very much indeed for joining us. But that's interesting. You're not buying stocks right now, or you're saying it's about risk management.
It's about risk management right now, and we're not buying until it settles down.
Diana, thank you very much. Diana Avigdor, VP and Portfolio Manager and Head of Trading at Barometer Capital Management. Right, so the Liberals got their budget through. One of their goals here, they say, is increasing competition in financial services. We're going to hear from the credit union industry after this. The Liberal government says it wants to increase competition in financial services, although no concrete legislation has been proposed yet. What does this mean potentially for the credit unions? We're joined by Michael Hatch, Vice President of Government Relations for the Canadian Credit Union Association. Thank you very much indeed for joining us, Michael. Really appreciate it. Of course, you're going to give your industry's viewpoint, or tend to. Well, that's what you're here for. But tell us, what is the problem with competition? Is there a problem with competition in financial services in Canada?
Yeah, well, look, I wouldn't think anybody would accuse financial services in Canada of suffering from a surplus of competition. Everybody knows the big players and the dominance of those players. Credit unions are some of the only competition that exists in the marketplace. So, we've been pushing the federal government to bring in measures, and these are technical amendments really at the end of the day, but to increase competition, to allow more credit unions to join the federal market, the federal space, as they are currently, for the most part, confined to their respective provinces. And the budget bill that we saw last night is a first step in terms of starting that process, and we're very encouraged by it.
So credit unions can, I understand, get a banking license, but it's a long Byzantine process.
Yeah, that's right. So, for the last decade or a little more, there's been an option for provincially regulated credit unions who are, for the most part, confined to their respective provinces to, quote unquote, go federal, join the national market, compete and grow, and seek deposits and members outside of their home province. Now, that legislative or regulatory option has existed since, I think, 2011 or 2012. But very few have gone down that road just because, as you say, it is a lengthy process. It is time consuming. It's very expensive in terms of, financial and human resources. So, we've seen not a large number of institutions take that option. So I think the thinking behind that option when it was first brought in was to increase competition, was to increase the number of institutions operating at the national level, which is, of course, a great idea. But now what we see is finally a federal government and a regulator, frankly, willing to look at this process, make it a little bit simpler, not to lower the standards necessary to join the federal market. Of course, OSFI, the national banking regulator, is a world-class regulator and a world-class, prudential standard setter. We just want to make the process a little bit more attractive so that more credit unions can join the national market, can go federal, can seek deposits and members, and compete at the national level, which ultimately will be good for competition and good for consumers across the country.
So, you look at the big credit unions, Meridian, et cetera, to name one in Ontario, they have ATMs, they have branches, they look like banks.
Of course, these are full-service financial institutions that have been operating in their communities and their provinces for decades, in some cases over a century, right? So this is a very well-established market. Again, we do provide some of the only competition that exists to the big 5 or 6 financial institutions in this country that everybody is aware of. And again, competition is not something that would necessarily characterize this sector in terms of its history over the last number of decades. And the same is true in other sectors of the economy. And now we have a government that's focused on that. Of course, cost of living is the number one political issue facing Canadians right now. There's very few direct sort of levers that a government can pull to lower prices. There's no magic wand that exists here to lower the price, of bread and eggs at the grocery store or financial services or air travel or whatever the case may be. But competition in any and all of these sectors, if you increase competition, that will have a downward impact on prices and inflation over time. And that's one, frankly, no-cost option that's available to the government, and we're excited and encouraged to see that they're pursuing it.
The Competition Bureau certainly seems to be in your camp. I'm looking at a submission from that watchdog last year, and they say that there's an urgent need to ensure robust competition. Concerns about weak Canadian productivity have brought out a renewed focus on the critical role of competition. And they say that borrowing costs have rapidly increased to their highest levels in a generation. Now, I'm not sure if they're just getting at interest rates or the fees or the spread maybe the banks are charging. I mean, certainly it seems plausible. Just the more players, the merrier in any market.
Yeah, of course. And that story is partially interest rate. Obviously, we're coming out of a historically low interest rate environment over the last number of decades, which, turns out perhaps was a bit of an anomaly. But there's other components that go into the overall cost of borrowing. Now, the Competition Bureau is a very important player at the national level. Their mandate is, of course, as the name would imply, competition. And their part of their role is to look at mergers and consolidation in our sector and in others. And there's an important distinction that I think your viewers should be aware of. Consolidation, mergers in most sectors, it can be associated with a reduction in consumer choice and a reduction in competition. And that's intuitively, it makes sense. If there's fewer players as a result of consolidation, it's intuitive that there's therefore going to be less competition. I would argue that the opposite is true in our sector, whereas credit unions, we have to be able to continue to consolidate, to continue to gain the scale that we need in order to continue competing with the massive federally regulated financial institutions. So whereas mergers and consolidation can often be seen as associated with a reduction in consumer choice, the opposite is true in our case. And that is a case that we're making not only to the government, but also to the Competition Bureau as they examine mergers and consolidation in the credit union sector, which is a trend that has been ongoing now for decades and will continue to do so as our members and credit unions across the country seek to gain the scale that they need to continue to compete.
We're tight for time. Do credit unions lend to corporations, small businesses much?
Absolutely. Collectively, the credit union sector is the biggest lender to small business across Canada. You know, if you're a barbershop or a laundromat or a restaurant in, Swift Current, Saskatchewan or Sydney, Cape Breton, and you're dealing with a credit union, you don't have to wait for a lending decision to come down from HQ on Bay Street in Toronto. We have that local knowledge. And of course, small business in particular are, deeply rooted in their communities across this country. It's a hugely important part of our economy, and credit unions are collectively the number one financer and lender to small business across Canada.
Is there any sense that you get, and of course you speak for the industry, but that small businesses find it easier to get loans from big bank, or from you guys, from your credit unions, than they would from the big banks? I mean, I've heard, for example, big banks, they want your house, they want security of your house before they'll advance any money to you.
Well, look, I can't speak for those institutions. I speak for the credit unions. And again, there's a reason I think that we are the most important lender to small business across Canada. And that is that local knowledge, that local connection. The fact that, again, we have been in those communities for decades, if not over a century. There's hundreds of communities across Canada, 400 plus communities across Canada where a credit union is the only physical presence in the community. So, for all of those reasons and more, we punch above our weight in terms of small business lending. And, I can't speak for the large banks, of course, but it's a hugely important component of our membership base.
That's a fascinating story. Michael, thank you very much indeed. Michael Hatch is Vice President of Government Relations for the Canadian Credit Union Association. Coming up, today's ETF report, we are going to look at some new funds that are based on Christian principles. We'll be right back. For today's ETF report, we're putting a spotlight on a couple of ETFs launched by an outfit called Capstone, and they're saying these are biblically informed ETFs. The idea here is to have exchange-traded funds that generate long-term growth and income by investing in companies that, in the fund manager's view, are consistent with biblical values. Apparently, they want to see businesses that promote human dignity, environmental care, integrity, and leadership. Well, probably every mutual fund manager would say that as kind of motherhood stuff. But here we get down to it. Companies involved in gambling, weapons manufacturing, pornography, or abortion are not eligible. Of course, that last one is going to be controversial. Some Christians probably would agree with the woman's right to choose. But fascinating that we do have this out there, and that we have a sample of some of the early holdings, the top holdings, in the Canadian version of this one, and there's a US one as well. RBC are in there. I'm not sure. I'll email Capstone. I'll ask them, well, what would you feel if RBC were to lend to a weapons manufacturer or a gambling company? How would you feel about that? Would do them doing business, or Scotiabank, or if AGF were to have some of its mutual funds in these industries that Capstone wants to evolve? Now, any ethical fund, it's difficult. I mean, where do you draw the line? It's not straightforward. Do you look for a company in an industry that you don't like, but you're looking for the best player in that industry, the most ethical player? But it's fascinating, and we'll be watching these ETFs to see how they do. That's today's ETF report. Coming in, we're going to check in on some stocks in the move, including Home Depot. Shares in MTY Group are down today, but of course they jumped yesterday after Reuters reported that the company was interested in exploring a possible sale, strategic alternatives. Now the restaurant franchisor and operator says it has launched a review process to explore options, including possible sale. The company says there's no assurance a transaction will occur. MTY owns restaurants such as Mr. Sub, Bacon Rouge, Extreme Pita, and Thai Express. And there's a look at Barrick shares today. The Financial Times and also Bloomberg has reported that Elliott Management, the aggressive hedge fund manager, likes to put pressure on executive teams, has bought a stake in Barrick. And the Bloomberg, like I think the Financial Times, is citing people familiar with the matter. Of course, we got the abrupt departure of Mark Bristow as CEO in September. Bloomberg arguing that Barrick has suffered from operational problems and cost blowouts. And apparently in the wind here is a possible breakup of the company into its Asian/African assets and then the North American crown jewels, which are in Nevada. Shares in Merck up about 4% after a mid-stage trial of its drug for a rare form of high blood pressure met its main target. Merck said the results show significant improvement and it plans to present the results at a future conference. The drug maker also intends to proceed with phase 3 development of that drug. North American markets are under pressure once again, and we have seen fresh selling in the giant US tech names today. The biggest loser, or the biggest traders in dollar terms, Nvidia and Tesla. Those, the desperate duo, are usually at the top of the list or near there. Nvidia's now down about 3%, Tesla the same, Microsoft down 2%. But Apple's down a little bit, but generally holding its own. Let's get more on movers south of the border. We're joined by Bloomberg breaking news editor Lara Sanley. Lara, thanks very much indeed for joining us. Talk to us about grocers and Kroger, please.
Kroger is taking a pretty big impairment in the next quarter. It's a $2.6 billion impairment charge. And what's at play here is really e-commerce. Kroger is working to improve its e-commerce, and that's something that costs quite a lot of money. It's been investing really heavily in fulfillment centers ever since the pandemic, when there was a surge in grocery delivery. But now it seems that there are other more profitable ways to handle this sort of thing, and competitors especially are moving toward fulfilling orders from stores, which is more cost effective. So Kroger is closing some of its fulfillment centers to take advantage of this. And it says this will improve its profitability by about $400 million in 2026. And then another thing that's impacting the stock this morning is also they announced in tandem that they're going to expand their partnerships with grocery delivery companies. So they expanded their partnership with Instacart, and they plan to launch on Uber Eats next year. So this is something else that should really aid Kroger's profitability and help its growth.
And there's going to be, it's bad news apparently for a company called Ocado, because that has been the U.S. partner of Kroger. And as you say, Kroger is closing 3 fulfillment centers. So it's seen as a hit for Ocado. I'm too stingy to order groceries online. And I actually like going out to the food store. What about you, Laurie? Do you ever order groceries online?
I walk to the grocery store and I climb all my stairs. I do it myself.
Yeah. Oh my God, up to those New York apartments. Yeah, I remember visiting New York.
Oh, yeah.
Yeah. Cloudflare, that company, it helps manage web traffic and apparently involved in an outage.
It's a pretty big outage. Everything is down from ChatGPT to X. All sorts of websites are impacted this morning. The company says it's working to restore the services, and it said it has been seeing some sort of recovery, but still a lot of websites remain down. Again, that's everything from ChatGPT to X to New Jersey Transit, all sorts of websites here. There was a surge in unusual traffic this morning that it says is related to this, and it doesn't yet know the cause, but it is investigating. It's aware. But I want to highlight that this company has experienced several outages over the past few years, and we've also seen a lot of other outages from other companies that had significant impact. There was an Amazon outage not too long ago. There was also the CrowdStrike outage last year. And really, this is highlighting just how dependent we are on just very few providers. So that's definitely something to think about.
You know, years ago, some friends of mine in the 80s, they lived in Alphabet City in New York, and it was a bit rough back then. My friends were bohemian, I remember. And one of them, I remember telling me, you know, the only time I got mugged was when I was drunk. I was out of my head and I was vulnerable. So it's probably been gentrified now anyway. Thank you very much indeed for joining us, Lara. Bloomberg's Lara Stanley. Home Depot down. There's weak remodeling demand. Let's get more from Bloomberg Intelligence home building analyst Drew Redding. What's the problem at the depot?
Yeah, so same-store sales up about 0.2%, missed consensus. For this particular quarter, it was largely due to weather. They're lapping a lot of storm activity from last year, which didn't replicate itself this year. If you back that out, it's about 80 basis points. So the underlying business really hasn't changed that much. They're running at about a 1% comp. I think the bigger issue is that they had previously expected an acceleration in activity in the second half of the year as interest rates came down. You know, the thought was that would boost the housing market, lift demand for bigger ticket projects, and that just hasn't materialized.
That's fascinating. And they also mentioned a lack of storms cutting demand for roofing stuff.
Sure. As I mentioned, they said storm activity was about an 80 basis point hit to the comp. One of the most important areas, as you noticed, their SRS business, which was a recent acquisition, did feel the pinch from storms. Roofing shipments were down significantly. But on the positive side for them, SRS was actually flat from a roofing perspective, so they are gaining share.
It is interesting. With Home Depot, you can see the stock down about 15%. Maybe we could put up lows just for purposes of comparison. So short-term interest rates have been coming down, but that doesn't necessarily mean mortgage costs drop. That would be a stimulus, presumably, for the housing market.
So we have seen mortgage rates come down from earlier in the year. We're in the low 6% range now. What's interesting, and we've been saying for a while, is that while mortgage rates get all the attention, and it's certainly, one of the most important components of overall affordability, it's not the only thing that's impacting the U.S. housing market at this point. We've heard from a number of builders, and the consensus really is that it's a lack of consumer confidence. Consumers are increasingly cautious about the outlook for the economy, for the outlook for their employment situation. And when you have such weak sentiment for something so important as your job, I mean, you're reluctant to take on bigger ticket projects. And when you think about Home Depot, that's really where a lot of the relative weakness has been in those big ticket discretionary remodeling projects like kitchen and bath remodels or flooring projects.
Right. And then, of course, they've had the tariffs aren't making life any easier. Flooring, home appliances, and other products have been hit by the president's levies.
Sure. So I think Home Depot and Lowe's, their scale should allow them to navigate the tariff situation pretty well. But to your point, they're not immune to it. They have said that they're going to selectively increase prices in the coming quarters. Now, we don't know exactly if there's been any impact from higher prices to this point, just because there's been so much noise in the quarter, particularly due to weather. But it is something certainly to keep an eye out going forward, is the elasticity as prices start to go higher.
Drew, thank you very much indeed for joining us. Drew Redding helping us out there. He is an analyst in home building at Bloomberg Intelligence. Coming up, hot picks. We're looking for 3 possibly safer stock picks in a frothy market. That's ahead. In this market, which many feel is frothy, our guest thinks that investors should look to less volatile stocks and perhaps ones that are less speculative and vulnerable to short selling. So that's what the theme today on Hot Picks. We're joined by Julian Klimochko, CEO and Chief Investment Officer at Accelerate Financial Technologies. Before we get going, Julian, that's interesting. One possible thing to bear in mind is go easy on stocks that can be driven down by short selling.
So what we want to chat about today is defensive posturing, because as you indicated, Andrew, this market is quite frothy. If you look at valuations, they match or exceed that of the tech bubble more than 25 years ago. You're seeing various bubbles in the market, whether it's quantum, nuclear, AI, and whether you want to call it a financial bubble or industrial bubble. Some things appear unsustainable and should give investors and allocators pause. And with that, searching for defensive type positioning. So what I want to chat about today is two longs and a short idea, or an idea for investors to exit in what we view as a riskier than average market.
Loblaw is your first idea, obviously a classic defensive stock. We all need to eat.
Yeah, you nailed it there, Andrew. It is highly defensive, Canada's largest food retailer. So even in a choppy market or an economic environment fraught with risk, we all need to eat. So we believe that they'll provide that consistency and stable earnings growth that really provides a good floor for the stock. Loblaw has a leading market position, attractive both absolute and relative valuation, high return on capital, good shareholder yield, combining share repurchases and a dividend. And more importantly, in this market, as I indicated, defensive positioning, Loblaw has a market beta of 0.5, meaning in a drawdown scenario, if the market were to correct 10%, we'd expect Loblaw to go down about half of that. In contrast, it's also provided strong upside participation, good stock momentum. So I think it's a solid defensive holding for equity investors in a current frothy environment.
Your next idea is Power Corporation of Canada, and of course, it's the parent company of the likes of IGM, the mutual fund giant, or Mackenzie, or Great-West Life.
Yes, so its diversified financial services business has been around for decades and decades, focused on insurance, wealth management, investment management. This is another steady Eddie stock that provides consistent low-risk growth in most market environments. And they've displayed strong recent business performance, various growth initiatives, intelligent capital allocation, in addition to share repurchases, a good dividend yield, and from a valuation perspective, still trades at a discount to its net asset value, which provides good valuation support for this stock. And lastly, with the beta of 0.6 again, reduced downside participation if we were to hit a market correction or bear market. This is a defensive stock that will really help provide that support in portfolios or reduced downside just versus the market index.
The yield about 3.5%. Of course, the run-up in the shares this year, they're up more than 54%, has tended to bring down that yield. But in a market like this, Julian, should you emphasize stocks that do at least pay some kind of dividend?
Yeah, I think it's important for investors to look at total shareholder yield, which takes into account not just the dividend, but share repurchases as well, because those represent capital returns. So we like share repurchasers. Some corporations that do pay a dividend actually have a much higher yield if you take into account repurchases, which also provide that buying pressure and can support the share price, particularly in a choppy market. So yes, dividend yield is important, but I think share repurchases are even more so.
And then you have a short idea for us, and we had a look at this stock earlier, a strategy, formerly MicroStrategy, and these days all it does is hold a bunch of crypto.
Yes, short idea, or perhaps if you're long MSTR, I'm advocating that investors take some money off the table and exit the stock. So strategy is what's known as a digital asset treasury company. All it does is it holds Bitcoin, and it gets a pretty tremendous valuation for just holding Bitcoin. It currently trades at 1.2 times its net asset value, or the underlying value of its Bitcoin. So either you could buy a Bitcoin ETF, or a Bitcoin's trading around $100,000 currently, or you buy MSTR, and pay $120,000 for Bitcoin. So, Andrew, it seems like a fairly easy decision to make. That premium has been declining pretty significantly. It's faced a ton of copycats in the market as entrepreneurs and executives have tried to replicate this Bitcoin treasury strategy. In addition, you've seen sort of declining sentiment on that type of business model, such that I expect this stock to trade down to a discount to its net asset value, and the whole machine sort of falls apart. It's heavily reliant on sort of the greater fool theory to convince more and more investors to buy this thing at a premium that I believe it's only a matter of time before that scheme runs out.
And finally, what about, is there any Canadian tech stocks that you like right now? I mean, Shopify, Celestica, Lightspeed, or any calling to you, Julian?
Yeah, I continue to like Constellation Software. It has been beaten down a little bit, not on fundamental performance, but more of this negative sentiment around AI potentially killing software. We really haven't seen that play out yet, so its valuation has become more attractive. And I previously advocated for Constellation as a longer term hold. And then Celestica, a good sort of shadow AI play that has had exceptional performance and seemingly a beat and raise quarter for the past, call it half dozen quarters. So it's performed exceptionally well, but it's really sort of tied into the whole NVIDIA data center growth story, which investors should keep a close eye on. But as long as these hyperscalers are spending hundreds of billions of dollars on AI data centers, then a name like Celestica should continue to benefit.
Thanks very much, Julian. Really appreciate it.
Thanks, Andrew.
Julian Klimoshko, CEO and Chief Investment Officer at Accelerate Financial Technologies. Why web browsers are seeing a moment of resurgence in the AI era. That's ahead. Mozilla CEO Laura Chambers says it's no surprise that AI companies are moving into the web browser space. She cites incredible access to a person's credentials, tabs, and how they spend their time. She calls this a, quote, moment of resurgence for the browser. She joined Bloomberg Businessweek Daily to break down web browser evolution and data privacy in the AI era. Let's have a listen.
It's a moment of tremendous change. One of the big shifts we're seeing is a really renewed interest in browsers as a category. Perplexity just launched their Comet browser. OpenAI just launched their Atlas browser. And it makes sense. The browser has been around for decades, and it's a product we use all the time, but we don't think about it very often. And it's not surprising that AI companies are getting into this space. The browser has incredible access into credentials, your tabs, where you're browsing, how you're spending your time. And as you know, AI companies are very hungry for that information. So it is sort of a moment of resurgence for the browser right now.
Is the browser the gateway to all of this? Or is it not, because we're using apps like Claude or ChatGPT?
What we're finding is that the folks that created those apps are feeling that the interface is a little clunky right now, that you might be in a browser and then you have to go to another tab and back and forth a little bit. And so I think that there will be a role to play for apps. But what we're certainly seeing from OpenAI and others is that they're really interested in getting into the browser space. But I think the browser is changing. The browser has traditionally been a container. You have a URL and a search bar, you have some tabs, and the browser renders content on the web for you. The shift that we're expecting to see is that the browser will become more of an agent to actually do work on your behalf in that browser interface. But with that shift becomes a big shift in power of data as well. The AIs now have more information about your credentials, where you're spending your time, where you're spending your money. And we know that people are worried about that. 60% of people in the US are really worried about privacy with AI. And the other 40% probably should be as well. And so I think to be successful in this space, people are going to have to go back to those values that Mozilla and Firefox are really built on, which is around privacy and choice and control over your experience and your data.
Do you feel like it's difficult to compete against the behemoths that are out there?
It's always challenging to be a smaller company. The big tech companies consolidate a lot of power. They lock you in. They have vertical integration. But it's something that is incredibly important to do. The internet, if left to its own devices, would always trend to being closed, to being expensive, and to just have a few players. And that's why it's important to have open source solutions. It's important for alternatives for Firefox, like Firefox, to be there. You know, we have our own browser engine called Gecko. There are only 3 browser engines left. Microsoft and Opera, everyone else moved over to Chromium. It's expensive to run a browser engine. I know why they did it, but we think it's incredibly important to invest in options like that, because very quickly, otherwise, you end up in a very, very sort of monopolistic world, which is bad for the health of the internet, and it's bad for the users of the internet.
So are you creating a web browser? Are you changing Firefox in order to be an AI-first browser so it can compete with whatever browser OpenAI ultimately has, whatever browser Perplexity ultimately offers, in the way Chrome changes from Alphabet's Google?
Yeah, at Firefox, we always adapt to where users are going and what they need. And not all of our users want AI. About 12% of users in the US actually don't want AI. So there'll always be an experience for them. But we just launched Smart Windows. We have signups for those available right now, which will be our version of AI. But it's going to be centered on privacy, on trust, and on transparency. So you'll be able to have a great AI experience in the Firefox browser, but it's going to be one that is really oriented around what users really need.
Laura Chambers of Mozilla, they say Firefox protects you from known third-party trackers, social media trackers, crypto miners. I need protection from that. Cookies and fingerprinting technologies. That's interesting. The AI, ever hungry for data, ever hungry for information about us, is exploiting browsers now. Let's have a quick look at the TSX and see how it's faring. Slipping a little bit today in tandem with US markets. And I'm not seeing a clear pattern in Toronto trading today, just on today's session alone. Enbridge a little bit higher. Told you about TELUS dropping because JP Morgan has cut to a sell. A bit of selling here in CIBC and Royal Bank. CIBC, though, trading near record highs. A couple of other stocks that are catching our eye here. There is ongoing weakness in these non-bank lenders. In many cases, they lend to people without the regular track record. EQB is a big mortgage player. They might lend to entrepreneurs who don't have an established employment record. That stock falling. There are worries just about bad credit possibly in the lending space. Propel Holdings, another player, also hitting its lowest in at least a year, and GoEasy hitting its lowest in at least a year. And a software stock that's been suffering, Docebo, which enables, among other things, training of customers on the web and training of employees too, I think. That stock out of favor. South of the border, let's have a quick look at the US markets. And you can see they are down. The NASDAQ down about 2%. The S&P 500 down about 1%. So it has not been a great November for the markets. Well, certainly over the past week or two. Interesting that we got through September and October fairly well, but November, which is usually a good period, week. And so far in November, the NASDAQ's down about 6%. The S&P 500's down about 3.5%. Toronto's down only about 1.3% for this month so far. And we told you about Home Depot. That one's suffering, saying consumers are pulling back. They're not buying. They're not shelling out on big purchases, for example. Thanks for watching the show.